to corporate America now. Big tech earnings in the US this week have delivered a clear message to markets. Investors are willing to tolerate massive AI spending, but only if it delivers growth. Now, companies that showed strong revenue momentum were rewarded, while those falling short faced swift punishment, underscoring how AI optimism is now tied tightly to earnings performance.
Big tech earnings so far this week have sent a clear warning. Investors are willing to overlook soaring spending on artificial intelligence if it fuels strong growth, but are quick to punish companies that fall short. The contrast was clear in Thursday's stock market reaction to earnings from Microsoft and Meta. The Facebook and Instagram parent jumped as much as 11% Thursday morning on strong sales, while Microsoft slumped 12% after its cloud business failed to impress. Meta has said it is benefiting from AI-bolstered ad targeting. That contributed to a 24% boost in quarterly revenue and a rosy first quarter forecast. The results show that its gains from AI were helping fund its capital spending, which is expected to jump as much as 87% to $135 billion this year. Microsoft benefited from its first-mover advantage with its investment in ChatGPT maker OpenAI to become the world's most valuable firm in 2024. But that has morphed into a possible drawback as OpenAI faces increased competition, including from Google's Gemini, which has won over massive customers such as Apple. Now Microsoft is under growing investor pressure to justify its soaring capital outlay. Microsoft reported revenue growth in its Azure cloud computing business that was only slightly above expectations. But despite Microsoft CEO Satya Nadella's insistence that AI remains in the early innings, the company spent more than $200 billion on the technology since the start of its fiscal 2024, and investor patience is waning.
And iPhone maker Apple surprised markets with a bullish outlook on Thursday, forecasting up to 16% revenue growth for the March quarter, far ahead of Wall Street expectations. Strong iPhone demand and a sharp rebound in China powered the upbeat guidance, sending Apple shares higher. Take a look.
Apple forecast a surge in revenue for the start of the year thanks to strong demand for its iPhones and its China business bouncing back. On Thursday, it estimated an up to 16% leap for January to March, well ahead of Wall Street's expectations. That came after a strong holiday quarter that also beat estimates. CEO Tim Cook told Reuters that hunger for the latest iPhone 17 lineup was staggering. The devices have been well received for their upgraded camera features and better performance. Apple also says it benefited from a wave of users replacing older phones. The company says the holiday quarter to December 27th saw the iPhone set sales records in every region Apple operates in, pulling in $85 billion, some $7 billion more than analysts had predicted, despite wider uncertainty in the economy. Sales in Greater China in particular jumped 38% year-on-year. Apple has faced pressure there from local rivals and regulatory scrutiny, but Cook said that the iPhone hit a sales record there. He said the iPhone 17 drove double-digit growth in the number of Chinese users switching from Android devices. However, Apple's results in the first quarter suggest the surging cost of DRAM memory and commodities like gold aren't showing up in the results yet. In a call with analysts, Cook said the global memory chip shortage would be a bit more of an impact on fiscal second quarter margins.
And another global corporate story, Samsung Electronics is warning that the global chip shortage could worsen this year, fueled by explosive demand linked to artificial intelligence. While the booming memory chip sales are boosting Samsung's core business, the AI surge is also creating pressure on smartphones and display divisions.
Samsung Electronics is forecasting a chip shortage will worsen this year, driven by the AI boom. The South Korean company on Thursday said its operating profit more than tripled to a record high in the fourth quarter. It underscores the strong pricing power of the world's top memory chip maker as the race to build artificial intelligence strains chip supply and boosts prices. With Apple and Samsung as customers, its shares fell 1.2% after a sharp rally this year. The company expected any expansion of memory chip supply to be limited in 2026 and 2027, while AI-related demand remains strong. Operating profit at Samsung's chip business, its main cash cow, surged 470% to a record high $11.4 billion in the fourth quarter from a year earlier. In contrast, its mobile profit declined by 10% to $1.3 billion, squeezed by the surging chip prices. The company's mobile and display businesses warned of a challenging year as they face cost pressures from memory price hikes. Samsung said it is already producing its next generation high bandwidth memory chips, or HBM4. It plans to ship them in February at the request of a major customer, apparently referring to Nvidia.